The best way to become comfortable calculating and interpreting ratios is to practice them with a full set of financial statements. In fact, for additional practice, you might find it useful to walk through financial statements for a company that you're familiar with, perhaps one that you've worked for or worked with in an internship or full-time capacity, one you studied in school, really any company that you have a working familiarity with both the business and perhaps their recent performance, which will help bring the ratios a bit more to life. But absent that, we're providing you a series of financial statements for a mock company here called Elson Co. What we have here are financial statements for 2 years. Now I want to point out that the year 3 financial statements are actuals, and they're basically saying here they're finalizing the numbers. They're probably not going to change much. You could imagine perhaps they're in the midst of their year-end audit coming down the home stretch. But they're also going to present projected figures for year 4. So what the CFO intends to do here is to use ratio analysis to explain here's where we are and here's where we think we're going to be, and then provide some interpretation. So over the next few slides, we're going to be using these financial statements in order to provide context for each of the ratios we're going to look at. First, here we have the income statement, very straightforward, not a lot of detail, and it's not necessary for the purpose of this exercise. We've got net sales, cost of goods sold, SG&A broken out, as well as interest and taxes. And then note at the bottom, although we do not have a complete statement of cash flows, we have been provided an excerpt from that statement with the cash flow from operations. And here on the next slide, we have the balance sheet. Again, not a great deal of detail, but that's all right for the purpose of our exercise here. You'll notice we've now added an additional year, and that's year 2. And I want to talk a little bit about why we've done that. In the lecture, you may recall that I noted that it is preferable, generally speaking, to use averages anytime you're comparing a balance sheet number to an income statement number or a cash flow number to be consistent, right? It's meant to be as close as we can get in an apples to apples comparison. And since the income statement or statement of cash flows carries information about a span of time, using an average of balance sheet numbers does at least an adequate job of doing that same span of time. However, the AICPA has already provided us a listing of the ratios and how they prefer them to be calculated. That's how they're presented in the textbook, that's how they're presented in this skills practice, and that's how they're presented for all the practice problems. And that's the way you should learn them for the exam. That being said, always pay close attention to the specific instructions provided in the question. If they want to deviate from that standard procedure for any reason, that's where they've got to say that. But bear that in mind that we are using a very particular set of ratios as provided by the AICPA. So bear that in mind. And that's why we did provide year 2, though. There are places where an average is what the AICPA prefers for you to use, and in order to do that, where we can look at year 3, we'll need to be able to take an average of years 2 and 3, at least from a balance sheet perspective. Okay, so for each ratio that we're going to look at, we're going to show you the calculation for both year 3 and year 4. We're going to discuss what drove the change in each of those numbers. It's important to understand how things are impacted as we look at the financial statements on these different ratios. And then we're going to draw an overall conclusion, whether it was a favorable or an unfavorable change. Now bear in mind, each ratio that we look at provides one piece of a much larger puzzle. Just because one specific ratio is favorable or unfavorable, that does not necessarily correlate to the company as a whole. It just provides you information about one specific aspect of it. So let's take a look here. The current ratio is expressed as current assets, and that's total current assets over current liabilities. And ideally, the bigger that number is, the better. That's the general consensus. Now, there's certainly an argument that if the number were too high, it might indicate you have assets that are sitting around and not really providing much use for your company. So we expect to see a current ratio above 1, and really how far above 1 is a matter of risk as well as a matter of what's typical perhaps for that industry. So the numerator here is current assets, and notice that it says we're expecting an increase in marketable securities and accounts receivable in year 4. That's what's driving an overall increase in the numerator. It also noticed that we're expecting a decrease in accounts payable. Well, a decrease in the denominator coupled with an increase in the numerator both will have the effect of driving that ratio up, and it does increase significantly from 1.04 to 1.25. So this is seen as a favorable variance because it's the idea that we will have more current assets in year 4 to cover current liabilities, which is really all the current ratio tells us, is our ability to meet those current liability commitments. All right, the next ratio we're going to look at is days in inventory. And again, let's walk through the components. Here, the numerator is ending inventory, which I'll abbreviate as EI. And the denominator is, well, there's a couple different ways to say it. The way I prefer to say it is this is cost of goods sold per day, right? Because we're dividing it by 365. And the reason that's relevant is it provides the turnover basically and expresses it in number of days versus the number of times per year they turn over their inventory. So here's what we see. We notice that there is a substantial increase. So I'll show that with 2 lines to show there's a substantial increase in inventory. In fact, nearly doubled year over year. So even though the cost of goods sold per day is also increasing, and those now would have counter effects on the ratio, or in this case on the number of days, because the increase in the numerator is so dramatic, that is going to drive an overall increase in the ratio, or as the number of days. And this is unfavorable. The idea here is that it's going to take the company more time to convert its inventory into sales, which is not preferable. Now, what does that tell us? Well, it might indicate that the company simply is growing and there's some inefficiency in its sales process. Perhaps they're very simply saying, look, we're going to have to stockpile a bunch more inventory than we've had historically to support our future growth. And that growth's not going to happen overnight. Again, context is everything, but certainly going from 19 to nearly 33 days is a little troubling. But again, we'd want to compare that year over year. It's also useful to compare that to other players in their industry. Now, a comparable ratio, I want to say comparable because how it's calculated and its general meaning are quite similar. This is days sales in accounts receivable. So it's more or less the AR counterpart to the inventory ratio we just looked at. In this case, the numerator is expressed as ending AR. So I'll abbreviate that as EA/R. And the denominator is sales, so I'll just abbreviate that S. Now, it is net sales, so if you see a number on the exam that includes, say, discounts and the like, it is net sales, not gross sales that you're expected to use. And in this case, this is sales per day. Again, to give us a ratio or give us an expression in the number of days. So what are we seeing here? Well, there's going to be a substantial increase in accounts receivable, and we're going to see an increase in the sales or the net sales per day as well. But just as we saw with the prior ratio, in this case, the numerator, I'm going to use 2 lines there to note it's the more dramatic increase. It's going to have a greater effect, leading us to an unfavorable variance in this. And again, take it as one piece of the puzzle, but this indicates that the company will take longer to convert its sales into receivables. Again, that's not ideal, but take it as a piece of the puzzle, but that is an unfavorable variance. Now, perhaps, again, if this is a company going through a growth stage, having to expand its operations, it is not at all uncommon for a company to recognize some inefficiencies. Basically, they may be saying, look, we've never had to operate at this size before, so that's creating some challenges for us. And it's going to take us time before we can refine our processes and get that efficiency back. So seeing these slowdowns could be indicative of that. But when we start seeing problems with AR, we also start wondering, are they relaxing their credit standards? Is it becoming more of a challenge to fully convert their sales through AR? Maybe that's cause for concern as well. Another important ratio is what's called the times interest earned ratio. And it gives you, at least in its title, a pretty good sense of what must be part of the calculation. One being interest. So we know interest expense has got to be somewhere, and that's our denominator. And the last word, earned, gives you a good sense of what goes in the numerator. And typically here that is EBIT, or for the case of this company, EBIT is operating income. So the idea is normally it would be operating income or EBIT. Generally speaking, you want to make sure it's before interest, because if you were to take earnings after interest, that would be a little weird when you're trying to compare interest expense. So it's basically saying, how many times do the earnings that we have allow us to pay our interest, right? Times interest earned. And what we see here is a pretty significant increase in that numerator, which is a good thing. It's an indicative that our operating income is increasing. And although we also see an interest expense increase, once again, the numerator is having a much bigger effect, and it's resulting in a favorable variance here, indicating they will have more operating income available to cover their interest payments. So that's a good thing. And again, much like the current ratio, as a lender, I'd be very interested in this because I'm thinking short term, are they going to make their interest payments? How safe is that? Long term, are they going to be able to repay the loan? Next, let's take a look at the debt to equity ratio, which, is as straightforward as it sounds. For debt, we're going to use total liabilities, so I'll abbreviate that TL. And for the denominator, the equity, we're going to use, shock and surprise, total equity. And what we see here is that liabilities are going to go up, but we also see that the equity is anticipated to go up. And for the first time from the ratios we've been looking at, it's that denominator that pound for pound is having a bigger effect on the ratio. So what we see here is the debt to equity is going from 2.0 to about 1.89. Now that is a favorable variance. The idea there is an expectation to have less risk because they are going to have more equity to support the increase in the debt. So the idea is saying, yeah, we know we're going to have to borrow more money, but the good news is we're also going to have a pretty good influx of equity capital to cover for it. So that's considered to be a favorable variance. Again, with a grain of salt, right? It's an indication perhaps of the risk and the risk tolerance of the company, where that ratio is, not to mention how the borrowers or the lenders may feel about lending their money to a company with such a debt to equity ratio. Okay, our next ratio is at least one that I think has certainly always held popularity. It's considered to be one of the key indicators, you could say a key barometer of the value of a company or the prospects of a company or how efficiently the company is making money with the equity you've put into it. That's ROE, or return on equity. Here, the numerator is going to be net income, NI, and the denominator, and here's a case where instead of using ending balances, and we saw that with some of the previous ratios where we were using ending inventory, we're using ending accounts receivable. In this case, we're going to use average equity. So we're going to take beginning plus ending and divide by 2. So what we're seeing here is that, net income is expected to increase. In fact, that's going to have the dominating effect, but the equity balance is also increasing. Now, what's notable about this is if we were to say go to year 5, then that average right now, that equity in year 4 is 23.25. If equity doesn't even move in year 5 because of the averaging, that's still going to have an effect on the ratio. But at least as we move from year 3 to year 4, we're seeing a favorable increase in profitability. The idea here is that the company is going to earn more income using or leveraging its equity capital, which is a good thing. Again, in a vacuum, it has some meaning. Compared to prior periods, more meaning, and compared to industry competitors, more meaning still, because it helps us to understand how their performance stacks up. All right, and the final ratio we're going to look at in this conceptual exercise is net profit margin. One more time, let's take a look at the numerator. Here is net income, just like ROE. And this time, the denominator switches from a balance sheet number to an income statement number. We're going to look at net income versus sales. Well, again, we know net income is going up. In fact, it's going to be the dominant effect here. Even though sales are also increasing, we're going to have a net favorable variance here from 9.4 to 10.6. And again, what that expects here is it's an expectation they're going to earn more bottom line relative to the increase in the top line, which is really a good thing, right? It indicates, hey, maybe we're growing and we're being more efficient about it. Or does it, right? One of the dangers for a company sometimes is as they grow, are they also staffing up to meet those growth needs? Are they trying to make do with the same number of people when in fact that might be putting too much strain on the organization? So it wouldn't surprise me to see that number settle out as well. But again, each one of these ratios just gives us a little glimpse or a little piece of a much larger puzzle. So what do they tell us overall? If we were going to try to put these ratios together and say, well, what conclusions could we draw? I would say this is a company that is gaining strength and size. There's a lot of good growth indicators, both in terms of the increases in some of the key numbers that we've seen and increases in some of those indicators that would say, yes, this is a healthy company. Drawbacks, though, we did see with day sales and AR and days days in inventory. There might be some declining efficiency as that growth is taking place that the company needs potentially to address. Well, let's see if that kind of general conclusion continues to make sense as you have a chance to work on some ratios. So in the practical exercise on the next page, go ahead and work through a series of ratios. Now these again will use the exact same company financials that we've just been looking at. With these, we're just going to be asking you to calculate some additional ratios we have not yet looked at. So good luck with those.